welcome to the Monday Futures Market Outlook for May 13th, 2013. This is Patrick Ceresna. As always, we start off with a chart of the U.S. dollar index futures, and the U.S. dollar has strengthened substantially over the last week as we have seen material breakdowns in a number of currencies between the yen, the Aussie, and the euro. Really at this juncture, this is going to be a critical moment because the euro, as you'll see on the next chart, is also approaching a key support line. If we see the euro begin a new drop lower at this juncture, it would more than likely equate to a U.S. dollar rally, which could see that breakout up toward the $85 level on the dollar index. So let's watch whether or not this follow through occurs. If we do see some good breakout that actually holds, then 85 is our upside target for this leg of the rally higher. Next year, when we take a look at the euro, this is where we're talking about the real potential move in the U.S. dollar. Now, we still are trading in the vicinity of the 130 level, so the official breakdown in the euro has really not happened yet. But if this rally that we've seen since the Cyprus crisis in March, this rally that we've seen over the last 6 weeks really starts to taper out and we see a new round of selling come in that euro, then we could see a euro that not only weakens back down to that 127.50 level, but we could actually see a critical drop lower that may even go back to the 2012 lows, which lie even as low as the 120 level on the downside. Now, while we're not necessarily forecasting that, it is something that we don't want to ignore, because when these currencies do make these big moves, they can be quite meaningful in the bigger picture on an intermarket basis. So spend some time watching that euro and see whether or not that breakdown move is engaged. That would really become U.S. dollar bullish in this next cycle. Next year, I want to take a look at the 30-year Treasury bonds, and we've gotten our first really good throwback in the bond market here, right down into a key Fibonacci zone. This is really going to be the make it or break it moment right along this 145, 144 kind of zone. Even though I don't have a focal point in there, it really is actually a critical retracement. At this stage, if this bond trend that we've been looking for is really a rally, then we should see a buy on dip on the bonds literally coming in at these price levels. Now, that doesn't mean that we can't see one handle lower on some short-term weakness, but this is sort of the zone where the buy on dip traders should really start to engage the Treasury bonds. If that's the case, we could end up seeing the 30-year Treasury bond end up breaking to a higher high in the summer if we really do see that support come in. In the same regard, if weakness continues and we see further selling, that weakness could retrace all the way back down to lows at 141, which we'd have to rethink and rechange our thesis on the bonds. But right now, we're looking for the buy on dip to see whether or not this support comes in. Next year, I want to take a look at copper futures, and we've certainly had a nice bounce in copper off of that little double bottom that occurred right around our 305 focal point. At this juncture, this is going to be we've seen a short-term trading low on copper, and we're now seeing that retracement. In fact, even though I have this 335 focal point drawn in here, there is another major support around the 350, 355 level, which certainly copper can still work its way higher, another 10 to 15 cents before really getting into some bigger overhead resistance levels. Whether it's this 335 level or the 350 level, we still have to remain very cautious on copper. If the U.S. dollar did have a breakout and that euro really broke down, that tends to pressure commodities weaker, and therefore the currencies suggest that we should not be too eager to be rushing to buy the dip on copper. So watch this. It doesn't necessarily mean that copper has to be at 275 or some kind of major lower level, but it certainly does act like an anchor to keep copper prices lower if that currency move did get engaged. So watch that euro and US dollar to kind of gauge that copper move. Next year, I want to take a look at crude oil, and crude oil remains impressively range-bound. There lacks any conviction for a move higher or lower as we see the testing on either side. We have for a while had a very distinct bearish bias looking for even $80 on the downside of crude. But with the way crude rebounds on the strength, there we have to at this point give some possibility to the idea that crude is going to be in a sideways range for a little bit longer. That doesn't mean we won't retest that $87 level on the downside during a period where the U.S. dollar is strong, but that far more bearish scenario of $80 to $70 on the downside may no longer be as probable as it was when we were looking at it earlier. And nonetheless, we are at overhead resistance, and it's likely that crude oil can likely have only a limited short-term upside before retracing back down. Next year, I want to take a look at gold. And gold hit that short-term low back down at 1350 and it's been retracing higher. We continue to see kind of gold struggling around this 1430 level. It is very natural for there to be a retest of the lows. And it doesn't have to come in a double bottom format where we go back down to 1350. But you know, at this stage, even another $20 or $30 lower to test 1400 to see whether supports and buyers come in on the dip is quite possible. You know, if we had a very pronounced U.S. dollar rally, there's always a chance that gold may yet have one more round of selling that may even see 1300 if the currency move is very pronounced. But overall, at some juncture, gold will be a very good buy on dip opportunity. So let's watch to see how the selling behaves here in the next month or two and where the real buying opportunity of gold really emerges. Finally, I want to take a look at the S&P 500, and right now we continue to consolidate around the 1630 level on the upside. There is a measured move that suggests even as high as 1645, 1650 could be achieved, but really at this stage we are very, very skeptical. While certainly there's all sorts of reasons to justify the bullishness on the upside, and you can have a whole number of sources suggest that to you, the risk-reward proposition is becoming increasingly bad. What we end up seeing is that the higher the market goes, the greater the likelihood that the magnitude of the correction will be that much bigger on the other side. And so while 2 months ago off the 1500 and 1550 level, we were looking for a modest market correction that would, let's say, be 100 S&P points of magnitude. If we hit 1650 on the upside, there becomes, let's say, an increasingly likelihood that the market correction may be 200 points in magnitude when it eventually comes around. It doesn't mean that the next even 3 weeks may end up seeing the markets continue to progress higher and higher, or even stay very range bound. So it's not like we're suggesting that it's imminent this week that a correction gets underway. But at this point, the idea of not taking your profits if you've been long the market, or at least building in hedges on your investments, to us is not a very good risk-reward proposition at all. So tread the waters carefully here. Just a quick review of our intermarket observations is that we continue to still see an optimistic scenario for the U.S. dollar, with the potential for it to get squeezed higher, particularly driven by the euro. At the same time, commodities represent a very average risk reward. Not like things like gold and copper are starting to get really cheap, but at the same time, the downtrend is pronounced, and the trend in the U.S. dollar will act like a wet blanket to prevent there being any robust push higher on the short term. At some juncture, we're looking forward to change that risk reward to good, or if not very good, but we don't feel that this is something that has to imminently occur. Bonds, we're going to remain optimistic on our risk reward as good, as we believe that this still may represent a buy on dip on the bond market. So we're just going to watch to see the price action. We may, if the bond market does not hold this 144 level on that 30-year, then there is always a chance that we may have to revisit our outlook and give it far more of a neutral bias. But at this stage, we're still going to stick with this one. At the same time, U.S. stocks and global stocks are very distinctly poor. There are some unique market scenarios where, like China and other things like that, that may potentially be a much better risk-reward proposition. But we have to look at the basket of all the global stocks, including all the European indices and things like that, which to us don't represent a very good opportunity. And so at this stage, we're more or less trying to hedge or reduce exposure to U.S. and global equity. That was your Monday Futures Market Outlook. Thank you for joining me.